Hi everyone, and welcome to a brand new episode. I'm Marcus, and today's episode we're looking at Home Depot, ticker symbol HD. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and the technical aspect of the stock. Should we be buying Home Depot? Well, let's find out. As I mentioned, we're looking at Home Depot, ticker symbol HD, and they are traded on New York Stock Exchange and are in the trade and service sector. If we go over to the screen, we can see that their market capitalization coming in at $304 billion and their revenues are $155 billion. The PE ratio coming in at 18. I like it because I like companies with a PE ratio of 20 or below. So having 18, that is a goal for me. Whenever you see a stock with a high PE ratio, that tells you that the market expectation of the stock is high, and therefore there are good chance that you see stock price increase because there's a lot of investor coming in and pushing the price even higher. Whenever you see a stock with low PE ratio, that tells you that the market expectation of the stock is low, and therefore it's not a good chance that you see capital gains on those stock. But having a PE ratio of 20 or below, that is acceptable number. Basically, it's telling you that you're paying less than 20 times of their earnings. So a lower PE ratio of 20, that is a good to go. Profit margin at 10.9, that is a bit low. Normally I'm looking for companies with a profit margin of 15% or higher. So coming in at 10.9, that is too low for me, so that is a no. Price to sales ratio at 1.2, I like it because I like companies with a price to sales ratio of maximum 4. So 1.9, that is a go for me. Price to book value at 1,294, that is just way overvalued, so that is a screaming no. Now they pay out a dividend of $7.35. I like it because I like those recurrent income. Effective return at 2.5%. That is a bit low, so that is a no for me. I would like to see a range at least around 3% to 6% or higher. But at the same time, guys, I don't want you to jump the gun whenever you see a stock with a high effective return because it could be a trap. You see, it could be that the overall trend of the stock is declining. They are moving in a negative trend channel, or they are consolidating, or maybe they are moving in a positive direction. But oftentimes, there's always if you see a stock with a high effective return, most of the time the stock is moving within a negative trend channel. And the risk is, sure, you get a good return as long as you hold the stock, but there is a good chance that you might not see higher price than what you bought it for when it comes time for you to exit the stock. So be very cautious here. Make sure to look at the history of the company and make sure to have a solid exit strategy. Okay, now return on equity coming in at 14.6%, a bit low but still acceptable numbers. Basically what it's telling us is return on equity tells you about the company's ability to create return on their equity. So coming in at 14.6, that is a bit low but still acceptable number, so that is okay. Return on assets coming in at 20.5%, that is a good to go. Now the stock is currently traded at $284 per share. If you go down to the moving average, we can see that we are below the 50-day moving average, but also below the 200-day moving average. Basically what it is telling us is that we might see the stock price decline. If we take a look at the chart, we can see that we have been moving within a negative trend channel here, but has of lately more or less been consolidating. So, but we'll take a closer look at the technical aspect of the stock further down. But let's head over to the income statement. And what we can see here is that the total revenue went from $100 billion up to $151 billion, and these numbers have been improving year by year. That is a plus. Gross profit went from $34.4 billion up to $50.8, and these numbers have been improving year by year, so that is a plus. Net income went from $8.6 billion and grew to $16.4 billion, and these numbers have been improving year by year. I like it, so that is a plus. Now let's head over to the balance sheet, and what we're interested in here is that the current asset assets versus the current liabilities, and we can see that there is a difference between the current assets and the current liabilities. Basically what we are seeing right now is if the company were to convert their current assets to cash, they are able to pay off their current liabilities, and that is a plus. But they are far from being able to pay off their total liabilities, and that is negative. Now if we take a look at the total liabilities, we can see it went from $43 billion and grew to $73.6 billion, and these numbers have been just increasing year by year. That is negative. Also, we need to take a look at why the debt is growing, also the rate which is growing, so keep that in mind. Outstanding shares went from 1.2 billion and down to $1 billion in 5 years, and we can say these numbers been dropping, but more or less been stagnated for a couple of years. Basically what is happening here is that the company is doing buybacks, basically meaning that your share of the company is growing, your pie of the company is growing, and because there are fewer and fewer available shares out there. Whenever you see these numbers increase, that means that you're being diluted as investor, meaning your share of the pot is decreasing, you're being diluted, because that's a way for a company to bring in more capital without taking on more debt. And there's a lot of people that either skip this part or doesn't know about it. But be very cautious when you see a stock that has a lot of assets, the debt's not growing that much, which is great, which is what we all are looking for. But at the same time, be careful and be cautious, because the company may issue a lot of shares in order to bring in more capital without taking on more debt. So keep that in mind. So seeing that these numbers are dropping, that is a plus. Now let's head over to the cash flow, and what we're interested in here is that the operating cash flow versus the capital expenditure. We can see the operating cash flow came in at $16.6 billion and the capital expenditure at $2.6 billion, making it a difference of $14 billion. That is just amazing. I like that. Now operating cash flow went from $12 billion and grew to 16.6, and these numbers have been improving year by year. We fell off a bit in 2022, but overall trend is positive. Capital expenditure went from 1.9 to 2.6, and these numbers have been improving. Fell off a bit in 2021, but overall trend is positive. These numbers are getting better and better, and they continue to invest in the business. That is a plus. I like that. Now let's head over to the key figures. What we can see here is that the earnings per share went from $7.4 per share up to $15.8 per share, and these numbers have been improving year by year. That is a plus. Revenue per share went from $87 per share up to $146 per share, and these numbers have been improving also year by year. That is a plus. Equity per share went from $1.22 down to 0.9 cents, and these numbers have been dropping, improved a bit in 2021, but overall trend is negative. Dividend per share went from $3.64 up to $6.7 per share, and these numbers have been improving. That is a plus, because I like those recurrent income. Also the fact that the income is growing year by year, that is a plus. And the dividend payout share went from 48%, a bit of fluctuation here, 48, 42, 53, 50, 42. I like companies that pays out between 20 to maximum 60%, because I want some of the capital to remain in the business for acquisitions, for investment, or just having the capital in order to strengthen their financials. So seeing that they are below 60%, that is a plus. I like that. Gross margin, a bit of fluctuation here, but we can see a range between 33 and 34%. So year by year, these are great numbers, but there is a lot of fluctuation. We see a range which is moving, but I would like to see head on that the company focus on trying to become more and more efficient, reduce the cost of goods sold. But overall, these are great numbers. I like that. Operating margin went from 13.5% up to 14.3%. Also same thing here, we're seeing a stagnation, a range which is moving between 13 and 14%. Also these are great numbers, but at the same time the company should look at could improve their operations, maybe cut some costs. But overall, these are great numbers. I like that. So that is a plus. Profit margin went from 88.5% up to 10.8%, and these numbers have been improving. Fell off a bit in 2021, but overall trend, that is a plus. I like that. Return on equity, as I mentioned, tells you about a company's ability to create return on their equity, and these numbers need to take a closer look at and see if we have got wrong data, but I need to take a closer look at this. Return on assets came in at went from 19.3% up to 22.8%, and these numbers have been improving year by year, but overall trend is positive, so I like it. Solidity, well, solidity tells us about a company's financial strength for the long term, and we can see we went from 3.2% down to 0.13%, and these numbers have been dropping. Improved a bit in 2021, but overall trend is negative. Balance sheet liquidity went from 0.7 down to 0.6, and these numbers have been dropping. Improved a bit in 2021, but overall trend is negative. Well, balance sheet liquidity tells you about a company's financial strength for the short term, and these numbers are dropping. Debt equity went from 29.6 up to 817, and these numbers have been growing. Improved a bit in 2021, but overall these numbers are is negative. Basically, in 2022, having 817 means that they had 817 times more debt than equity in the business, and no, I'm not liking this at all. Now, guys, we have gone through the income statement, balance sheet, cash flow, key figures. Now over to a key feature, which is our stock analyzer. Basically, what it does is that it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we take a look at the screen, we can see right away that the PE ratio is below 20, which is a plus. They pay out a dividends, which is a plus. Dividends payout share is less than 60%, that is a plus. And dividends have increased over the past 5 years, that is a plus. And the number of outstanding shares have been dropping, and that is a plus. Revenue increased over the past 5 years, that is a plus. Profit margin below 15%, that is negative. And profit increased over the past 5 years, that is a plus. And the current assets are greater than the current liabilities, that is a plus. Solidity decreased over the past 5 years, negative. Balance sheet liquidity, we need to take a look and closer look at these numbers, but the software reporting that these are negative, so that is negative. Debt equity ratio increased over the past 5 years, that is negative. And the total liabilities have been growing over the past 5 years, that is negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. You can have this software along with everything we've gone through, plus access to our discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to commerce.sc and become a member today, okay? Thank you. Now let's take a look at technical aspect of the stock. So here we have the chart. Let me just lay down some lines here. We can see right away that we are moving within a positive trend channel here, and have been doing so for quite some time. And basically what we can say here right away is that we are moving within a positive trend channel, and the numbers are great. It's a great company, but there are some concerns. For instance, they need to improve some of the financials, the balance sheet liquidity, solidity. That is not, it's growing rapidly, but overall we're looking at a interesting buying opportunity, as we can see that we are ranging within the trend channel. So basically we could see something like this, that the price start moving back down closer to the support line for a later push upwards the resistance level over here. Basically we could see a potential price move of 20%. That is acceptable levels. So basically if you are looking into buying this stock, there's a great buying opportunity I see here, because if we look at the history, we could see that these support line have held for multiple times, making a strong level. We broke out of here, then a lot of buyers came in and pushed the price back within the channel. So basically, I think by looking at the history of this stock, we might see a potential buy over here and just have that and just stay on that stock for a long time. This is a large and stable company, and there's a possibility here to buy and hold and get some dividends while owning that stock, at the same time having capital gains on those stocks. So I'm liking what I'm seeing right here. So this is a potential buy for me. Guys, this is all we have for Home Depot. I hope you have enjoyed this episode, and please give me a thumbs up, comment, subscribe, and let me know what you think in the comment section below, and also what stocks you want me to take a look at. I hope you will come back for more. Until next time, guys, take care. Bye bye.